Good morning and welcome to Earnings Echo. While my bosses were asleep, we put together the most important information about Affirm holdings. And honestly, this one is a bit of a head-scratcher. I was looking at the print early this morning and it looked like a total victory lap green across the board. But then I looked at the stock chart and the market is acting like they tripped at the finish line. Help me square that, because the headline numbers look huge.
They were huge. I mean, this was what you'd call a definitive double beat. Firm didn't just inch past expectations. They blew past them. They reported revenue of $1.12 billion.
Which was well over the 6 billion consensus.
Comfortably. And the bottom line was even better. Earnings per share came in at 37 cents.
37. That's significantly higher than the, 27-cent forecast?
Around 27, 28 cents, yeah.
So a massive beat on profit, a beat on revenue, and gross merchandise volume, essentially the total dollars flowing through their system.
It climbed 36% year over year.
That is a roaring engine. Yet despite all that, the stock dropped about 6% in after-hours trading. It's the classic beat and fade. It feels like investors are completely ignoring the scoreboard.
They are. They're just staring nervously at the weather forecast. The fade is happening because the market is pivoting from looking at execution, which was, flawless in Q2, to looking at risk.
Okay.
But before we get to the fear, we have to acknowledge what's driving that 36% growth. The composition of their business is changing right under our noses.
Right. It's not just about financing Pelotons anymore. It's the Affirm card.
Exactly. The Affirm card is doing the heavy lifting now. Card GMV grew just under 160% year over year.
160%. Wow.
And active cardholders surged 121%. This is crucial because it changes the relationship with the user.
That's the habit thesis playing out. If I use Affirm for a Peloton, I see the app once a year. If I use the Affirm card for groceries, I'm in the ecosystem every single day. They are successfully converting from a lender to a daily wallet. But even with that success, the active merchant base numbers had a weird asterisk next to them. They grew 42%, but there was a catch.
Yes, that growth is driven largely by wallet partnerships, not so much direct integrations. And we can't ignore the drag. They are transitioning off a large merchant partner. The market assumes this is the lingering effect of the Walmart exit or something similar.
Okay, so that hurts the concentration metrics.
It does. But the real red flag, the thing that likely caused the sell-off, was inside the credit provisions.
The rainy day fund.
Precisely. The provision for credit losses rose to $214.2 million. Now, management says they are managing this, attentively and using short-term loans to control risk. But when you set aside that much cash for bad loans in this environment, you're effectively signaling that you are bracing for impact.
You're telling the market, we think the consumer might stumble.
Exactly. And that's the disconnect.
So you have this stellar Q2 performance, but then you look at the guidance for Q3, and it looks like they're tapping the brakes.
They are. The Q3 GMV guidance is set between $11 and $11.25 billion. Now, $11 billion is a lot of money, but it implies a growth rate of roughly 30%.
Which is a deceleration from the current 36% pace.
It is. And in the world of high-growth tech, going from 36 to 30, that scares people.
It kills the momentum narrative. And then there's the margin question. They kept talking about RLTC. For everyone listening who doesn't live in a spreadsheet, RLTC is revenue less transaction costs. It's their real revenue, right?
It's their take rate, basically, after they pay Visa and MasterCard their cut.
So where did that land?
Management reaffirmed that RLTC margins would remain slightly above 4% for the second half of the fiscal year. It's healthy, it's stable, but investors were maybe hoping for a more aggressive margin expansion story.
To offset the slowing growth. So you have slowing growth and flat margins. That's a tough combo. But here's where it gets really interesting. On the call, the CEO, Max Levchin, he was adamant that the consumer is quite healthy.
He's basically telling the market, you're wrong to be scared.
Exactly. And to prove it, they dropped a massive partnership announcement with Intuit's QuickBooks.
This was the highlight for me. It's not just another retail partner, it's structural. This partnership integrates Affirm financing directly into service invoices.
Think about the magnitude of that shift. Until now, Affirm was mostly B2C, helping you buy sneakers or a couch. This moves them into B2B.
It does. It's helping a plumber, an accountant, or a graphic designer get paid by their client over time.
That transforms them from a nice-to-have checkout button into essential business infrastructure.
It absolutely creates a much stickier ecosystem. And it expands their total addressable market significantly beyond just retail. It's a smart hedge against a retail slowdown.
So if we strip away the noise and the panic, what is the core investment story here?
The story is a company successfully pivoting from a buy now, pay later lender to a daily financial habit and now a business service provider. However, the echo for investors today is clear. The market is currently pricing in a consumption slowdown and credit risk via those rising provisions.
So those macro fears are just overshadowing the operational beat.
Completely. It's a battle between the scoreboard and the forecast. The company is winning the game right now, but the crowd is worried the stadium lights are about to go out.
Definitely one to watch closely as that QuickBooks integration rolls out. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.